The collapse of Lehman Brothers in 2008 was not just a fall of a financial giant. It was a seismic event that reshaped the global economy. What caused one of Wall Street's most historically influential institutions to crumble overnight? Why did a bank with over 150 years of incredible innovation and success become the epicenter of the greatest financial crisis since the Great Depression? This is not just a story about numbers or markets. It's a story about risk, ambition, and the fragile nature of trust in finance. In this text, we'll unravel the mysteries behind Lehman's rise and fall, explore the extraordinary impact of its collapse on the world, and uncover the lessons that still echo through financial systems today. Prepare to dive into one of the most fascinating and cautionary tales of modern economic history, the rise of Lehman Brothers and its influence on modern finance. The story of Lehman Brothers begins in 1850, when three brothers, Henry, Mayer, and Emanuel Lehman, established a small dry goods business in Montgomery, Alabama. What began as a modest family enterprise would evolve into one of the most influential financial institutions in history. This transformation came through their recognition of a key opportunity, shifting from trade to the commodities markets, particularly in cotton. By tapping into the burgeoning cotton trade, they positioned themselves at the heart of an economic revolution. It was this innovative approach that laid the foundation for their legacy, showcasing their extraordinary business acumen. Over time, Lehman Brothers expanded its operations, embracing investment banking and capital markets. By the early 20th century, it had become a key player in underwriting securities for industrial giants like General Motors and RCA. Their intelligent diversification into equities and corporate finance marked them as pioneers, shaping how modern banking supported corporate America. This pivotal role established Lehman as an engine of innovation and progress, driving the incredible growth of U.S. industries. In the post-World War II era, the bank's influence only grew. Lehman Brothers was instrumental in mergers and acquisitions, advising companies during a wave of consolidation that reshaped the global economic landscape. Their work in this area was historic, as they facilitated deals that redefined entire industries. For example, Lehman helped guide Philip Morris through its acquisition of Miller Brewing, a landmark transaction of its time. The late 20th century saw the firm adapt to the changing nature of finance, embracing global markets and expanding its reach internationally. Lehman Brothers ventured into derivatives, asset management, and real estate, staying at the forefront of economic trends. Their ability to foresee market shifts made them an extraordinary force in an increasingly interconnected financial world. The influence they wielded was unmatched, as they not only participated in but shaped global financial systems. Lehman Brothers also stood out for its commitment to innovation, pioneering new financial products and strategies. By embracing computerization in the 1970s, they revolutionized how transactions were conducted, enhancing efficiency and accuracy. This was a pivotal moment for the industry, showcasing how technology could unlock extraordinary potential. Their example encouraged other financial institutions to modernize, forever altering the nature of global finance. However, behind this remarkable history of success lay the seeds of future troubles. The bank's meteoric rise was accompanied by growing risks, including over-leveraging and exposure to volatile markets. The very strategies that once made Lehman historically influential began to shift toward speculative practices. This growing fragility foreshadowed a turning point in their story, one that would ultimately lead to their dramatic collapse. And so, the tale of Lehman Brothers began its transition from a story of triumph to one of caution. But how did a bank with such an extraordinary legacy of innovation and influence come to symbolize the mysteries and perils of modern finance? That's where we begin to uncover the deeper lessons of their fall. The subprime mortgage crisis and Lehman's risky bets. Lehman Brothers' downfall is intricately tied to the subprime mortgage crisis, a phenomenon that unraveled the financial world starting in the mid-2000s. At the heart of this crisis was an extraordinary surge in housing loans extended to borrowers with questionable creditworthiness, known as subprime mortgages. Banks like Lehman eagerly embraced this market, drawn by its seemingly limitless profit potential. They packaged these loans into mortgage-backed securities, MBS, which were then sold to investors. For a while, this strategy appeared innovative, fueling a housing boom that seemed unstoppable. However, this extraordinary growth masked a deeper issue. The loans were inherently risky. Many borrowers were unable to meet their repayment obligations, and when the housing bubble burst, defaults skyrocketed. Lehman Brothers, heavily exposed to this toxic debt, faced an avalanche of devalued assets. Their financial foundation, once built on innovation and intelligence, was now crumbling under the weight of poor judgment and excessive greed. The allure of short-term gains blinded the bank to the long-term consequences of its choices. Lehman's leadership doubled down on these investments, increasing their exposure to subprime mortgages even as warning signs became evident. This decision was driven by the perception that the housing market was invincible. Yet, this assumption ignored a simple truth. Markets are inherently cyclical. Their strategy turned into a gamble, one that history would prove devastatingly wrong. Here lies a critical lesson. Curiosity without caution in financial markets can lead to extraordinary failure. The firm's high-risk approach wasn't limited to mortgages. Lehman also expanded aggressively into collateralized debt obligations, CDOs, and other complex financial instruments linked to subprime loans. While these products were marketed as innovative, they were laden with hidden vulnerabilities. Rating agencies, incentivized to provide favorable assessments, gave these instruments high ratings, fueling investor confidence. But when the underlying assets failed, their true fragility was exposed, leading to catastrophic losses across the industry. Lehman's collapse revealed a fascinating paradox. The same strategies that once brought them incredible success now hastened their downfall. Their focus on financial engineering, while historically influential, became a double-edged sword. This misstep highlights the importance of not just intelligence in crafting strategies, but wisdom in foreseeing potential consequences. The broader economic system, too, failed to detect or address the accumulating risks, compounding the crisis. The bank's relentless pursuit of profit at the expense of prudence alienated many of its clients and investors. As defaults increased, the firm's reputation took a hit. Investors began withdrawing their support, and counterparties hesitated to engage in transactions, further isolating Lehman from the financial system. It was as if the very nature of trust, so vital to banking, evaporated overnight. This chapter in Lehman's story underscores the mysteries of market behavior, where confidence can transform into panic in the blink of an eye. But the real question is, when the cracks began to show, why didn't the systems in place act to prevent the disaster? That's where the story deepens into the fascinating interplay of power, negligence, and missed opportunities. The role of liquidity and asset devaluation in Lehman's collapse. As the subprime mortgage crisis unfolded, Lehman Brothers faced a dire liquidity crunch. Liquidity, the ability to quickly convert assets into cash without losing significant value, is the lifeblood of any financial institution. For Lehman, this became an extraordinary challenge. The firm held a vast portfolio of liquid assets, including real estate investments and complex financial products like mortgage-backed securities, MBS. When the market turned against these assets, their value plummeted, leaving Lehman with little room to maneuver. The reliance on illiquid assets was a gamble rooted in overconfidence. Lehman believed that the housing market downturn was temporary and that their assets would recover value. However, as the crisis deepened, the firm struggled to sell these assets without incurring massive losses. This created a feedback loop. The more Lehman tried to offload its holdings, the more prices fell, further devaluing its portfolio. It's a stark reminder of how even the most intelligent strategies can unravel when they ignore the unpredictable nature of markets. The extraordinary pace at which Lehman's liquidity evaporated revealed the fragility of the financial system. As investors and counterparties began to question the firm's solvency, they pulled back from engaging in business with Lehman. This loss of confidence sparked a run on the bank. with clients withdrawing funds and refusing to renew credit lines. Even Lehman's historically influential status couldn't shield it from this cascading loss of trust. Compounding the problem was the role of credit rating agencies. These agencies downgraded Lehman's debt as its financial health worsened, making it harder for the firm to secure short-term funding. The downgrades also triggered collateral calls, forcing Lehman to provide more security for its borrowing. This drained liquidity even further, accelerating the downward spiral. It's a classic case of how external pressures can amplify internal vulnerabilities in extraordinary ways. Lehman's leadership attempted to raise funds by seeking outside investors and selling parts of the business. However, these efforts were hindered by the firm's deteriorating reputation and the broader financial turmoil. Potential investors, wary of the risks, hesitated to inject capital into what seemed like a sinking ship. Even discussions with government officials and rivals failed to produce a lifeline, leaving Lehman stranded in the storm. One of the most incredible aspects of Lehman's collapse is how quickly it unfolded. In just a matter of weeks, the firm went from being a cornerstone of global finance to filing the largest bankruptcy in U.S. history. The sheer speed of the crisis highlights the mysteries of financial contagion, where panic spreads faster than reason. It's a sobering reminder of how interconnected and delicate the global financial system truly is. This chapter in Lehman's story sets the stage for deeper questions. Could the collapse have been prevented if interventions had come sooner? And what role did systemic failures play in allowing this extraordinary downfall to spiral out of control? The answers lie in the controversial decisions and missed opportunities that followed, as we'll see in the next phase of this saga. The loss of investor confidence and the domino effect. The collapse of Lehman Brothers was not a solitary event, but part of a larger domino effect fueled by the loss of investor confidence. In finance, trust is paramount. Without it, even the most extraordinary institutions can crumble. For Lehman, this trust eroded rapidly as doubts about the firm's solvency spread. Investors, once eager to align with Lehman's historical influence, began pulling their capital and refusing to engage in trades, amplifying the firm's financial distress. This sudden withdrawal of support created a liquidity crisis, leaving Lehman unable to meet its short-term obligations. It's a vivid illustration of how market sentiment can transform into a self-fulfilling prophecy. As whispers of trouble circulated, panic replaced rationality, and Lehman's clients raced to withdraw funds, fearing they would be left empty-handed. This loss of confidence became a runaway train, dragging the firm deeper into an extraordinary spiral of instability. A critical tipping point came when Lehman's counterparties began to back away. In the interconnected web of global finance, banks and firms rely on one another for funding, trades, and operations. Lehman's growing isolation left it without crucial partners to shore up its liquidity. The firm's inability to secure funding through repurchase agreements, repos, and other short-term mechanisms magnified its vulnerability. This isolation demonstrates the extraordinary interconnectedness of financial institutions and the devastating ripple effects when one link in the chain falters. Credit rating agencies played a significant role in solidifying the panic. As Lehman's credit ratings were downgraded, many institutional investors, bound by regulations to avoid low-rated securities, began liquidating their holdings. This massive sell-off further devalued Lehman's assets and damaged its reputation. The downgrades also triggered collateral demands, forcing Lehman to scramble for cash it simply didn't have. This process highlights the mysteries of financial systems, where a single downgrade can unleash catastrophic consequences. Efforts to restore confidence, including potential bailouts or mergers, failed to materialize. Talks with potential buyers such as Bank of America and Barclays faltered as these institutions balked at Lehman's toxic asset portfolio and the risks associated with assuming its liabilities. Without a buyer or government intervention, Lehman was left to fend for itself in a hostile market. It was an incredible display of how systemic failures and a lack of coordinated action can accelerate a financial collapse. Lehman's downfall also revealed the fragile nature of interbank lending. As trust evaporated, banks began hoarding cash, unwilling to lend even to seemingly solvent institutions. This credit freeze spread beyond Lehman, stifling liquidity throughout the financial system. The extraordinary speed and scale of this contagion underscored the deep interdependencies in global finance, making it clear that Lehman's problems were far from isolated. The loss of investor confidence marked a turning point, shifting Lehman from a precarious position to an unavoidable collapse. But it also raised profound questions about accountability and foresight. Why were warning signs ignored? And how did a firm with such an incredible legacy fail to secure the support needed to survive? These questions bring us to the dramatic moments leading up to Lehman's bankruptcy filing, where the stakes became higher than ever. The weekend of negotiations and missed opportunities. The final days of Lehman Brothers were marked by frantic negotiations and extraordinary attempts to salvage the firm. On the weekend of September 13 to 14, 2008, senior executives, government officials, and Wall Street leaders gathered in an urgent effort to prevent the collapse of one of the most historically influential financial institutions. These meetings, held at the Federal Reserve Bank of New York, were a last-ditch attempt to stabilize Lehman and prevent its bankruptcy from triggering a wider financial crisis. The focus of the discussions revolved around finding a buyer for Lehman Brothers. Potential suitors included Bank of America and Barclays, two institutions with the capacity to absorb Lehman's assets and liabilities. However, the extraordinary risks tied to Lehman's toxic assets proved a major stumbling block. Barclays expressed interest, but required a guarantee from the U.S. government to cover potential losses, a request that the Treasury and Federal Reserve adamantly refused. Government officials, led by Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke, faced a critical dilemma. They had previously orchestrated bailouts for Bear Stearns and other struggling institutions, but this time they chose a different path. Their decision not to use taxpayer money to rescue Lehman reflected mounting political pressure and a desire to avoid setting a precedent of unlimited intervention. This controversial stance became one of the key mysteries of the crisis. Why was Lehman left to fail while others were saved? Inside Lehman, the mood was one of desperation and disbelief. Executives scrambled to present revised proposals and cut deals, but time was running out. Employees, many of whom had spent decades at the firm, watched helplessly as their futures unraveled before their eyes. The bank's long history of extraordinary resilience seemed to be evaporating in real time. It's a stark reminder of how quickly fortunes can change in the volatile world of finance. As Sunday evening approached, it became clear that no lifeline was forthcoming. With no buyer, no government bailout, and no means to address its liquidity crisis, Lehman had no choice but to file for bankruptcy. The firm's extraordinary influence on global markets and its interconnectedness with countless institutions turned its collapse into a seismic event. It was a moment of reckoning that sent shockwaves through the financial world. The missed opportunities during this weekend haunt the narrative of the 2008 financial crisis. Could an earlier intervention have averted the catastrophic domino effect that followed? Or was Lehman's fall an unavoidable consequence of years of over-leveraging and reckless risk-taking? These questions continue to provoke debate, illustrating the incredible complexity of balancing market stability with moral hazard. This weekend of failed negotiations set the stage for a broader unraveling. As Lehman prepared to file for bankruptcy, the global financial system braced for impact, unaware of the extraordinary chaos that was about to unfold in the days and weeks to come. The filing for bankruptcy and its immediate impact. On September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy, marking the largest bankruptcy filing in U.S. history. With over $600 billion in assets and $600 billion in liabilities, the sheer scale of Lehman's collapse was extraordinary. The filing signaled not just the end of an era for one of Wall Street's most historically influential institutions, but also the beginning of a global financial meltdown. The shockwaves were felt immediately as markets around the world plunged into chaos. Lehman's bankruptcy set off a chain reaction. The firm's counterparties, many of which were heavily intertwined with Lehman's operations, scrambled to assess their exposure. Hedge funds, banks, and asset managers rushed to unwind their positions, triggering fire sales and further destabilizing asset prices. It was a textbook example of systemic risk, where the failure of a single entity sent ripples across the entire financial system, creating extraordinary uncertainty. On Wall Street, the impact was devastating. Lehman's collapse caused a complete freeze in the credit markets as institutions grew fearful of lending to one another. The once liquid markets for short-term funding dried up overnight, leaving businesses and banks struggling to secure essential financing. This liquidity crisis spread quickly, revealing the fragility of the global financial system. The domino effect was in full motion, with even firms that seemed solvent suddenly facing existential threats. Lehman employees were among the first to experience the personal toll of the bankruptcy. Thousands of workers were left jobless, their futures uncertain. The sight of Lehman staff leaving their New York headquarters with boxes of belongings became a powerful and enduring image of the financial crisis. For many, this wasn't just a loss of a job, but the collapse of a career built over decades in one of the most prestigious institutions on Wall Street. The markets reacted with extraordinary volatility. The Dow Jones Industrial Average fell 500 points on the day of Lehman's bankruptcy, marking one of its largest single-day drops at the time. European and Asian markets followed suit, reflecting the global interconnectedness of the crisis. Lehman's collapse also led to a surge in credit default swap spreads, signaling a growing mistrust in the ability of other financial institutions to weather the storm. Governments and central banks around the world scrambled to respond. The Federal Reserve and Treasury initiated emergency measures to prevent further collapses, including the bailout of AIG just days later. Central banks injected liquidity into the markets, but the fear and panic unleashed by Lehman's bankruptcy proved difficult to contain. It became clear that the crisis was not just an American problem, but a global one, requiring extraordinary coordination across nations. Lehman's filing for bankruptcy was not just a financial event, but a profound psychological one. It shattered the belief that any institution was too big or too influential to fail. The question now was how the global economy would cope with the cascading effects of this incredible failure, and whether the world's leaders could stabilize a system that seemed on the verge of collapse. This uncertainty set the stage for the extraordinary policy interventions and debates that would follow. The global repercussions of Lehman's collapse. Lehman Brothers' collapse in September 2008 was not just a U.S. tragedy. It became a global economic catastrophe. As the epicenter of the financial crisis, Lehman's bankruptcy triggered extraordinary ripple effects that exposed vulnerabilities across international markets. In the immediate aftermath, stock markets worldwide plummeted, erasing trillions of dollars in value. This wasn't just about financial institutions. Entire economies felt the shock, with some entering deep recessions from which recovery would take years. In Europe, banks like UBS, Deutsche Bank, and Royal Bank of Scotland were heavily affected due to their exposure to Lehman and the broader financial turmoil. Governments across the continent were forced to step in with massive bailouts to prevent their banking systems from collapsing. Iceland, a small but financially significant nation, suffered an extraordinary economic crisis as its banking sector imploded, leading to a national bankruptcy. The fragility of global interconnectedness became painfully apparent. Asia, despite its geographic distance from the epicenter, was not spared. Export-driven economies like China, Japan, and South Korea faced sharp declines in demand as Western consumers tightened their belts. The incredible growth that had defined these nations slowed dramatically, and stock markets in the region tumbled. Lehman's bankruptcy highlighted how deeply integrated global financial systems had become, with no nation immune to the fallout. The real economy bore the brunt of the crisis. Unemployment rates soared as businesses struggled to secure credit. Industries such as manufacturing, retail, and construction faced extraordinary challenges as consumer confidence plummeted. The ripple effects extended to households, with millions losing their homes, savings, and jobs. Lehman's collapse wasn't just a Wall Street event. It became a symbol of the vulnerabilities inherent in global capitalism. The crisis also provoked a historic response from governments and central banks. The U.S. Federal Reserve implemented extraordinary monetary measures, including slashing interest rates to near zero and launching quantitative easing QE programs to inject liquidity into the economy. Similar actions were taken by the European Central Bank, the Bank of England, and others. Globally, stimulus packages totaling trillions of dollars were introduced to stabilize markets and revive economic growth. Lehman's downfall also spurred international cooperation to prevent future crises. The G20 summit in 2009 marked a turning point, as world leaders pledged to reform financial regulations and improve oversight. Institutions like the International Monetary Fund (IMF) took on a more prominent role in supporting struggling economies. However, these efforts also revealed tensions between nations with differing priorities, showcasing the extraordinary complexity of global governance. The global repercussions of Lehman's collapse reshaped economic policies and attitudes toward risk forever. It forced nations to confront the mysteries of modern finance, how interconnected systems amplify crises, and how fragile stability can be. As the dust began to settle, the world looked to the future, wondering what lessons could be learned from such an extraordinary failure. The stage was set for a new era of financial reform, yet questions lingered. Could another Lehman-like event happen again? And would the changes implemented be enough to prevent it? The cultural and historical legacy of Lehman Brothers. The fall of Lehman Brothers became an extraordinary cultural and historical milestone, symbolizing the devastating consequences of unchecked risk and overconfidence in financial systems. Beyond the immediate financial chaos, Lehman's collapse left a deep imprint on how societies understand and engage with global capitalism. It wasn't just the bankruptcy of a bank. It was a bankruptcy of a belief system that trusted in the invincibility of Wall Street. Lehman Brothers had been an iconic institution, a historically influential player that helped shape the growth of modern finance. For over 150 years, the firm stood as a beacon of innovation, from underwriting industrial giants to leading the charge in financial engineering. Its dramatic rise and fall became a cautionary tale of how the very strategies that build success, like leveraging innovation and curiosity, can spiral into extraordinary failure when unchecked by prudence. The cultural response to Lehman's collapse was swift and widespread. Films like The Last Days of Lehman Brothers, 2009, dramatized the final hours of the bank, humanizing the crisis and offering viewers a behind-the-scenes look at the tension and chaos. Books, documentaries, and academic studies poured over the mysteries of the crisis, dissecting how one institution's downfall triggered a global economic disaster. Lehman's story became a cornerstone of finance courses, a case study in risk management, and a warning to future leaders. Public sentiment toward Wall Street shifted dramatically in the wake of Lehman's bankruptcy. The financial crisis it represented spurred widespread anger and frustration, particularly as ordinary people bore the brunt of the fallout. Movements like Occupy Wall Street emerged as a direct response, calling attention to inequality, corporate greed, and the extraordinary lack of accountability among financial elites. Lehman Brothers became a symbol of excess and irresponsibility, galvanizing a global conversation about the need for reform. For the financial industry, Lehman's fall forced a reevaluation of practices and priorities. Regulators introduced sweeping reforms, such as the Dodd-Frank Act in the United States, aimed at reducing systemic risks and increasing transparency. Concepts like too big to fail became central to debates about how to prevent future crises. Lehman's legacy serves as both a benchmark for understanding risk and a reminder of the extraordinary consequences when safeguards fail. On a deeper level, Lehman's story is one of hubris. It reflects the tension between innovation and caution, ambition and discipline. The firm's rise was marked by an intelligent embrace of new markets and strategies, but its downfall revealed the cost of ignoring limits. This duality gives Lehman's history a universal quality, resonating far beyond finance to touch on broader themes of human behavior and organizational dynamics. As we reflect on the cultural and historical significance of Lehman Brothers, one question lingers. Has the world truly learned from its mistakes? Financial systems have evolved, but the complexities and mysteries of global markets remain. Lehman's legacy reminds us that vigilance and accountability must always be at the forefront to prevent history from repeating itself. Yet, as we'll see in the next segment, not all the lessons of Lehman's collapse have been fully embraced. Lessons learned in the debate over financial reform. The collapse of Lehman Brothers remains one of the most extraordinary cautionary tales in financial history, offering invaluable lessons about risk, governance, and the interconnected nature of global markets. One of the most critical takeaways is the need for vigilance in risk management. Lehman's overexposure to subprime mortgages and its reliance on illiquid assets underscored how unchecked ambition can lead to catastrophic results. Firms and regulators alike were reminded that intelligent strategies must always be tempered with caution and foresight. In the wake of Lehman's bankruptcy, governments and institutions around the world implemented sweeping reforms. In the United States, the Dodd-Frank Wall Street Reform and Consumer Protection Act introduced measures designed to curb systemic risk, such as stricter capital requirements, increased transparency, and stress testing for major banks. Globally, the Basel III framework established new standards for liquidity and leverage, aiming to ensure that banks could withstand extraordinary economic shocks. These changes reflected a collective effort to prevent another Lehman-like collapse. However, the effectiveness of these reforms remains a subject of debate. Critics argue that while progress has been made, some of the root causes of the 2008 crisis persist. For instance, the phenomenon of too big to fail continues to dominate the financial landscape, with major banks growing even larger since Lehman's collapse. Others question whether the complexity of new regulations has created unintended vulnerabilities, leaving smaller institutions struggling to compete and adapt. Lehman's downfall also highlighted the importance of corporate culture and governance. The firm's leadership, driven by short-term gains, failed to address growing risks or heed warnings about the fragility of its financial position. This failure underscores the need for organizations to cultivate a culture of accountability and long-term thinking. Boards and executives must prioritize sustainable growth over extraordinary but fleeting profits, a lesson that remains as relevant today as it was in 2008. On a broader scale, Lehman's collapse reshaped public perceptions of finance. The crisis it triggered revealed the mysteries and complexities of modern markets, sparking demands for greater transparency and fairness. The rise of fintech, decentralized finance, and ESG environmental, social, and governance investing in recent years reflects a growing desire for more ethical and innovative approaches to wealth creation. These trends can be seen as a direct response to the erosion of trust caused by events like Lehman's bankruptcy. At the same time, Lehman's legacy serves as a reminder of the limits of reform. Financial markets are inherently dynamic, constantly evolving in ways that can outpace regulation. This means that vigilance is not a one-time effort, but an ongoing process. Policymakers, industry leaders, and investors must remain curious and proactive, continuously adapting to new challenges and opportunities. As we consider the lessons of Lehman Brothers, the ultimate question becomes, are we better prepared today to handle extraordinary financial shocks? While significant progress has been made, the historical significance of Lehman's collapse is a reminder that vigilance and humility must remain at the heart of global finance. But as the next chapter of this story suggests, the true test lies in how the world reacts when the next crisis inevitably arrives. Could another Lehman-like collapse happen again? The question of whether another Lehman-like collapse could occur remains one of the most pressing mysteries of modern finance. Despite the extraordinary efforts to reform the global financial system since 2008, vulnerabilities persist. Markets today are larger, faster, and more interconnected than ever, creating an environment where systemic risks can escalate rapidly. While safeguards have been implemented, they may not fully address the complexities of a constantly evolving financial landscape. One of the key lessons from Lehman's fall is the importance of liquidity and confidence in maintaining market stability. Today, financial institutions are required to hold more capital and meet stricter liquidity requirements under regulations like Basel III. These measures aim to ensure that banks have a cushion during crises. However, in an increasingly digitized and globalized market, the speed at which panic can spread remains extraordinary. A modern financial crisis could unfold even more rapidly than in 2008, with technology amplifying both risks and responses. Another area of concern is the ongoing too-big-to-fail phenomenon. Many of the largest banks have grown significantly since 2008, consolidating their influence on global markets. While this has made them more robust in some respects, it also increases the stakes if one of them falters. The interconnectedness of these institutions means that a failure could still trigger a cascade of extraordinary consequences, despite the safety nets now in place. The rise of new financial instruments and technologies has added another layer of complexity. Innovations such as cryptocurrencies, decentralized finance, DeFi, and algorithmic trading introduce both opportunities and risks. These emerging sectors operate outside traditional regulatory frameworks, creating potential blind spots. For instance, a major collapse in the cryptocurrency market could spill over into traditional finance, testing the resilience of the safeguards put in place since Lehman's fall. Economic trends also play a critical role in shaping financial stability. Rising global debt levels, geopolitical tensions, and the risks associated with climate change all present new challenges. These factors create uncertainty that can exacerbate market volatility. Lehman's collapse demonstrated how extraordinary economic shocks often arise from the convergence of multiple factors, and today's world is rife with potential triggers. Despite these risks, there are reasons for cautious optimism. The lessons of Lehman have fundamentally altered the way institutions and governments approach financial stability. Stress testing, macroprudential policies, and international cooperation have strengthened the system's ability to withstand shocks. Central banks, in particular, have become more adept at responding swiftly to crises, as seen during the COVID-19 pandemic, when unprecedented monetary interventions helped stabilize markets. Ultimately, the possibility of another Lehman-like collapse hinges on our ability to remain proactive and vigilant. The world of finance is extraordinary in its ability to innovate and adapt, but these qualities can also lead to new risks. Lehman's legacy serves as both a warning and a guide, reminding us that even the most historically influential institutions are not immune to failure. The future of global finance depends on how effectively we can balance innovation with responsibility, ensuring that history does not repeat itself. Lehman Brothers' collapse stands as a powerful reminder of the extraordinary consequences of unchecked ambition, systemic risk, and the fragile nature of global finance. The lessons from its downfall are clear. Vigilance, accountability, and innovation must be balanced to avoid repeating history. But have you truly applied these lessons in your own financial decisions? Are you actively learning and adapting to ensure resilience in a world full of uncertainties? If this story has inspired you to dig deeper into the dynamics of finance, subscribe to the channel and hit the notification bell. Let's continue exploring the forces that shape our world and learn how to navigate them intelligently. Together, we'll uncover the tools to turn knowledge into opportunity.